1. Understand what you own. Before you invest a single dollar, ask yourself one simple question. Do I actually understand this business? If you can't explain how the company makes money in 1 or 2 sentences, you don't own an investment, you own a mystery. And mysteries don't build wealth. Clarity does. Know the story, know the engine behind the profits, and only then decide if it's worth owning. 2. Classify the stock. Every stock has a personality. Is it a slow grower, a stable performer, a rocket ship, a turnaround story, a cyclical play, or an asset play with hidden value? Your expectations must match the category. A fast grower can double quickly, but collapse just as fast. A slow grower pays steady dividends, but won't make you rich overnight. Name the category, and the strategy becomes clear. 3. Study the earnings. Earnings are the heartbeat of a company. Are they rising consistently or bouncing around with no direction? A company with smooth, predictable earnings gives you stability. A company with chaotic earnings gives you stress. Always follow the trend. It tells you whether the story is strengthening or weakening. 4. The PE ratio test. Price to earnings is a simple truth teller. It shows what the market is willing to pay for each dollar of earnings. But here's the key. A high PE isn't bad, and a low PE isn't automatically good. The real question is whether the P/E makes sense based on the company's growth, industry, and past performance. The number isn't the answer. The context is. 5. The PEG ratio logic. The PEG ratio combines growth and valuation into one powerful score. A PEG near 1 means you're paying a fair price for the growth you're getting. A PEG way above 1, you're paying for hope, not reality. A PEG well below 1, you may have found a hidden gem. This is where buying great companies at fair prices becomes possible. 6. Check the debt. Debt is leverage until it becomes a weight. A great business with too much debt can collapse under a single downturn. But a well-managed company with low debt can survive storms, expand confidently, and seize opportunities. Ask yourself, if earnings dip tomorrow, could this company still breathe? If the answer is no, move on. 7. Inspect profit margins. Profit margins are the signature of efficiency. A rising margin tells you the business is getting stronger. A falling margin tells you something is slipping. Margins reveal competitive pressure, management skill, and operational health. Long before the news does. Follow the margins, and you follow the truth. 8. Cash flow. Matters more than earnings. Earnings can be engineered. Cash flow can't. Cash tells you whether the business is actually generating real money, money it can use to expand, innovate, pay down debt, or return to shareholders. Before you trust the earnings, look at the cash. 9. Watch the inventory. For retailers and manufacturers, inventory is the pulse of demand. When inventory rises faster than sales, trouble is brewing. The company is overestimating demand. When inventory falls or normalizes, especially after a slump, it can signal a powerful turnaround. Inventory tells the story before the headlines do. 10. Identify real growth drivers. Where is the growth coming from? Is it new stores, new products, new markets, new technology, or expanding demand? Or is the company simply squeezing out gains from cost cuts and accounting tricks? Real growth creates longevity. Artificial growth burns out. Always know what's fueling the engine. 11. The competitive advantage. Does the company have something the competition can't easily copy? A brand, a patent, a cost edge, a network, a culture, a technology? If the answer is yes, that advantage becomes a moat. If the answer is no, competition will eventually erode profits and shrink opportunity. Never underestimate the power of a durable advantage. 12. Insider buying. When insiders buy shares with their own money, they're not guessing. They're signaling confidence. Insiders sell for many reasons: taxes, life expenses, diversification, but they buy for only one reason. They believe the stock is going higher. Follow the people who know the business better than anyone. 13. Institutional ownership. Early institutional ownership often means the smart money is just starting to notice the company. Crowded institutional ownership means the easy gains are gone. Everyone already knows the story. Big money moves markets. You want to enter before they stampede. 14. Dividend strength. A dividend is a promise, and a promise must be backed by earnings, cash flow, and financial strength. Before you fall in love with the yield, ask, is the payout sustainable? Does the company have a track record of raising dividends? Is the business stable enough to support future payments? A safe dividend is power. An unsafe dividend is a trap. 15. The long-term story. A stock isn't just a number. It's a story unfolding in real time. Are customers still loyal? Is the product still relevant? Is the trend still in motion? If the story breaks, the stock breaks. But if the story strengthens, the stock follows. Always invest in the story, not the noise. 16. Prepare for what could go wrong. Every investment has risks. Your job is to know them before they surprise you. Ask yourself, if the market dropped 20%, would I still believe in this company? If sales slowed or competition increased, would the long-term thesis still stand? Conviction doesn't come from ignoring risk. It comes from understanding it. 17. Look for a catalyst. A catalyst is the spark that turns potential into momentum. A new product, a new CEO, a turnaround, a cost improvement, a new market opening. When the fundamentals are strong and a catalyst appears, the stock can move faster than the story alone. 18. Valuation versus expectations. The market doesn't price what a company is. It prices what the market expects it to become. If expectations are already sky high, even great execution might not move the stock. But if expectations are low and the company quietly over-delivers, that's where fortunes are made. Expectations shape opportunity.